Hello, this is Dr. Adam J. Bach. In these audio presentations, we're going to discuss financial planning and statements for startup technology companies. Please note that the activity that's associated with these presentations is a large-scale activity that you'll probably want to complete after you've watched both of these. It is something that you need to plan to invest a reasonable amount of time in. I strongly encourage you to complete it with a colleague and to expect to invest a certain amount of time looking up outside resources, outside websites, information on financial statements. The expectation is that you have some familiarity with financial statements already, but some students enter this course without the appropriate, without the real prerequisites that should be required. And so this in particular may present some real challenges to students who are unfamiliar with some of this material in advance. So we're going to be talking about a series of topics: the basics of financial planning and documentation, and then the details of revenue and cost projections, moving on to then profit statement, balance sheet, and cash flow statement. We'll briefly talk about the challenge of realistic projections and scenario and sensitivity analysis. And then the follow-on presentation will begin addressing issues associated with metrics, specifically break-even analysis, briefly mention ROI and ROE, and then really get into the cost of growth, which is then where all of this will come together into the large-scale activity that you'll do. To understand the basics of financial planning, you need to understand that ultimately there are three core financial statements that all businesses utilize: income statement, also known as a profit and loss statement, a balance sheet, and a cash flow. We distinguish between financial statements of the past, which report what's happened already, from financial projections going forward by calling those projections pro forma financials. But generally speaking, they use the exact same formats as traditional financial statements. Every startup company that I've ever run, the financial projections were simply, the pro forma statements were simply projections forward of the existing financial statements: the income statement, the balance sheet, and the cash flow. Sales and costs combine into the income statement, but it's really, really important to remember that for most organizations, profit is not the same as cash flow. That is ultimately a result of two factors: one, accounting principles and the way we account for activities of the organization on our books, and two, the reality that operationally, not everything happens with cash in exactly the same way. So here's a very simple example. You have an employee. That employee does 2 weeks of work, and then you pay that employee. Well, the cash goes out at the end of 2 weeks, but if, for example, after the end of the first week, that employee has created a product which you can sell, you theoretically could have income without having any of the actual cash out associated with it, because you haven't paid the employee yet. So that's just one simple example of why our issues with profit and cost and income measurements don't always match up with the cash flow. The goal of the financial statements and analysis is to appropriately match those together so that these statements are a reasonably accurate reflection of what's really going on at the organization. So we'll start with just understanding the sales and revenue projection. This is almost certainly going to be the most contentious analysis when you are presenting to investors. And for technology entrepreneurs, this is often really frustrating because you know your product works. Every tech entrepreneur believes that their product will work and will sell tons and tons and tons immediately, and everyone will love it, and everybody's going to make $1 billion. Unfortunately, that's not usually how it works, and investors are appropriately skeptical about this. And so they're going to look at this extremely carefully, in particular because it's one of the things that you're likely to know the least about, the reality of how many customers will actually buy this at what price. Sales projections are usually done one of two ways: top-down versus bottom-up. Top-down is the most common way. Basically, what you do is you take the market size. We might say, well, the market for bicycles is $10 billion a year globally, and our goal is to get 1% of that market, and therefore if we accomplish that, we would have $100 million of sales per year. And it's a wonderful, simple way of trying to get some idea of how big your market is, and the hard part about this is that no one believes it. Investors hate it. It's totally unconvincing. The issue is that it's purely arbitrary. We'll get 1% of the market. And entrepreneurs usually say something like that because they think, oh, well, 1% is so little, who could argue with it? And the answer is anyone sophisticated will argue with it. They know that you're making that up. There's no basis for why you're choosing 1%. And it often contradicts what the entrepreneur is saying elsewhere in a pitch presentation. For example, the entrepreneur will say something like, our product is 10 times better than anyone else's product. But we're conservatively estimating that we're only going to get 1% of the market. Well, that's just foolishness. If your product is so much better, you should be getting 100% of the market. And it just goes to show that the 1% is a made-up number. So be very careful with this kind of analysis. It's very tempting, but it's almost always wrong. A real sales projection is done bottom up. That means you identify the number of actual target customers times the price that they're likely to pay. And in particular, you identify those customers based on name or market segments, how many there are in a given geographical area, how many of them are likely to purchase, and so on. This is much harder to do. It often requires a significant amount of data collection, which entrepreneurs would prefer to avoid if they can. But most venture capital firms and professional investors will require this type of analysis to really get a sense of how big the market is and how quickly you can actually make those sales. Another thing to keep in mind is that you have to scale sales up. You don't simply enter the market and suddenly everybody who can buy will buy. This is a question of how many customers you can reach, how long the sales process actually takes, and then when do you even recognize the income and receive the cash. In this kind of analysis, your focus needs to be on accuracy rather than specificity. What does that mean? Well, it's great to say that you believe that there are 16,221 potential customers. That's extremely specific. The question is it accurate? If the way you've arrived at that number is by some kind of very high-level guesstimate, the odds are that it may not be very accurate. It's much better to have an accurate estimate than an inaccurate but specific number. So please be very careful about this. If you're not clear on the distinction between accuracy and specificity, take a look at it. There's no shortage of examples online that'll help you understand that better. And then something to watch out for is it's very common for entrepreneurs to call their revenue projections conservative. Entrepreneurs are under the impression that saying that makes investors feel better. It actually makes them more worried because it suggests that you don't really know what you're talking about. You should show the sales estimates that you believe. Don't say that you're underestimating your sales estimates just to make it sound better. That never works. Nobody buys it. So here's an example from your textbook. It's a month-to-month sales projection. Notice that this is built on a bottom-up analysis, hopefully, where you have a price per unit and the number of sales that the organization thinks it can generate. Note that it has this huge jump from month 2 to month 3, which presumably is when the product launches. And then you'll notice that it's a much slower ramp-up month to month after that. And that's the sort of thing you may or may not expect depending on what your sales process looks like. These then get aggregated to years, and ultimately then put into a more sophisticated income statement. The second part of an income statement, of course, is your cost projections. Unlike the revenue projection, which everybody understands are going to be estimates, your cost analysis should be very specific and very accurate. Your textbook provides an example of the kinds of analysis that would go into this. You notice that this is dramatically more complex than what's shown on the revenue projection, and that's because you should know what your costs are likely to be. You should know how much it costs to produce your product, how much it costs to run your organization, how much it costs to do sales, and so on. You can also use this to compare against industry averages and competitor data. It's very likely that any investor with some sophistication will have industry-level data, and if you're suggesting that your sales will run about 2% cost of revenue and industry average is 20% cost of revenue, they're going to ask you about that, and you better have an awfully good explanation for why you're running at such a different level than the industry average. Don't underestimate your expenses. You need to incorporate appropriate salaries for all employees and managers, including the founders. Very often entrepreneurs make a somewhat silly assumption that they're going to work for free for a while. That doesn't make any sense for a couple of reasons. One, it underestimates your realistic costs. Two, investors want you to be paid. They want you to eat. They want you to be able to pay your rent. And they don't want you out there doing consulting work for another company in order to make ends meet. They want you 100% focused on making this venture work. So you should incorporate appropriate salaries for yourself as a founder or manager. And then just watch out for certain investor rules of thumb. For example, when we were running our angel network and investing in software companies, we had a very basic rule of thumb, which is software takes twice as long and costs 3 times as much to develop as the entrepreneurs claim. And that's because in many cases entrepreneurs are working with best case scenarios where there don't need to be any changes to products as they're developed, and those are usually very, very unrealistic. So you don't need to build those into those kinds of estimates. You should build your analysis with the best data and information that you have, but be prepared for what might be going on behind the thoughts of behind the perspective of your investors, and be prepared for some of the questions that they might ask. Especially when there's development work to do, and especially around software, you might find that you have to build shorter check-in points in order to have a compelling story about how quickly you're going to be able to bring product to market. This leads you then to hopefully an income statement. I've provided one here that you're going to get to take a look at later on when you do your activity. Notice that these can get complicated very quickly. And in particular, when dealing with projections, as I mentioned, specificity is not as important as accuracy. The point is that these kinds of statements and projections serve an important purpose. You're trying to convey useful, actionable information about how an organization actually operates. So the idea is that someone who kind of knows what they're doing can quickly glance at this and say, oh, this looks profitable, or I can see where your problem is, or how are we going to fix this? If your P&L statements are so complicated that someone can't do that, then they're not actually serving the purpose or the intent of what you're trying to do. Second major financial statement or part of a pro forma is the balance sheet. This, simply put, identifies the assets and liabilities of the business. It operates on a key equation, which is that total assets equals total liabilities plus shareholders' equity. This is the foundational analysis that goes into all accounting. You should be aware of that equation, even if you're not completely sure exactly what it means. But what it fundamentally says is that a balance sheet must in fact balance. If you have a balance sheet where total assets don't equal total liabilities plus shareholders' equity, then that means that something has been done, information has been tracked or identified incorrectly. We're not going to do a lot with balance sheets other than when you get to the activity, and even there what you're going to be doing with it should be relatively straightforward. Because a balance sheet in particular requires real direct knowledge and experience with accounting, and that's technically not a prerequisite for this course. But you should know what the following things mean: cash, equipment, inventory, receivables, payables, debt, and equity. If you can't quickly give a one-sentence description for any of those items, then you need to go back and try to pull them as best you can from the textbook or other resources online. There's no shortage of online dictionaries and accounting resources that can help you understand each of these items, but you need to understand what they mean. You don't need to know it in depth, but you certainly would need to be able to identify them on a balance sheet and briefly explain what they are. Your textbook has an incredibly simple balance sheet example, which doesn't have most of the items that you'd find on a normal balance sheet, which I understand. But I want you to be prepared for what you're likely to see and to at least be willing to play around with it. So again, here's the example you're going to be working with a little bit later on. It's a little more realistic. It shows most of the basic items that you'd see for a startup company. Note at the bottom the check line. All that's doing is it's taking total assets and then subtracting out total liabilities and owner's equity to see if the balance sheet actually matches. And so with the workbook that you'll be using, the nice thing about it is that if that checks automatically, and in fact those cells will turn red if it finds a problem. And so you'll be able to keep an eye on that because, I'll talk a little bit more about that when I'm preparing you to launch into the activity. Final statement is the cash flow statement. This is incredibly important because for a startup, cash is king. Arguably, this tells you whether the company is alive or dead, because companies can be profitable but have no cash, or they could be unprofitable but have lots of cash. And the bottom line is that if you have cash, then your company is alive. And if you don't have cash, then your company is probably dead. Cash flow statements are often the hardest to understand. We instinctively think we understand profit and loss statements, although they're surprisingly tricky. Balance statements are quite complicated because we often don't understand the underlying elements, but we get a sense of what they mean. The stuff at the top, the assets, are things that the company owns and have value, and things towards the bottom are things that the company owes or are potential value detractors. The other problem, but cash flow statements are a little trickier because they're often divided into areas that we don't fully have a sense of: operations, investment, and financing. Most startup companies usually don't have a lot in the investments area. They do tend to have a lot in the operations and financing areas. The other problem is that formatting is not always fully standardized, and so sometimes you have to look carefully because different cash flow statements are formatted very differently. And in particular, in Europe, cash flow statements often look very, very different than they do in the United States. So here's an example again from your textbook. This is monthly, just as the other one was. You'll notice that it starts with the net profit or loss from the income statement, and then what it's basically doing is adding back a bunch of things that were technically not cash, but showed up on the profit and loss statement. And that generates this cash flow from operations. So in other words, how much cash are your operations actually generating? Investing is how you may have spent that cash, things like purchasing capital equipment. And then how much financing did you do? And you can see this is circled here. In the first month, this company appears to have gained a bank loan and then also received money from investors. So it's important to recognize that then all of this flows together, so you can see what the how much cash the organization started with, how much it increased or decreased that month, and then what the total cash balance is at the end. Here's a slightly different example, basically now aggregated year on year. This is basically taken also from that workbook that you'll be using. There are some items on it that are not obvious. Depreciation, particularly complicated. Just know that it's the idea behind depreciation is if you buy a large piece of equipment, you actually don't expense that from an accounting perspective because you use it for a long time. So the idea is, oh, it's a piece of equipment that we're going to use for 5 years, so it cost $1 million, but we're only going to allocate $200,000 of that per year again as an expense against our income. Again, this is that distinction between cash and profit. We certainly had to spend the cash for it, but in terms of how profitable we are, it would be silly to charge all of that our first year. Capital expenditures show up on here, as well as any change in equity or debt. So just be careful about this. The bottom line ultimately is, does the company have cash or not? And you can see that at the bottom there. In this particular example, the company does have cash. It's changing a little bit year in and year out. It's important to understand a couple of things about the financial statements. The balance sheet is a snapshot. It's at one instant in time, whereas the cash flow projection, the cash flow statement, and the profit and loss statement are showing how much has changed in a given time frame, like a given year. So do recognize that. You have two of them which are basically recording changes, and one of them which is a snapshot. So you do need to be aware of that distinction. It's really hard to make good projections. Things to remember. Number one, the data is out there, right? Just because you don't know what the answer is or what the number is doesn't mean the answer and number aren't out there somewhere. Usually the problem that entrepreneurs have is tracking this stuff down takes a ton of time. You need to find people who know more than you. And for many entrepreneurs, that's so frightening that they're unwilling to do it. If you really, really can't find a number, or you can't find the data you need, then it's better to provide an estimate with a rationale than simply to guess. And one of the things that you should do is be identifying all the assumptions that you're making as you go through this, so that if investors say, how did you come up with this number? And you say, well, I couldn't find something specific, so here's how I estimated it. And then they'll say, well, that's not how we would have estimated it. Why don't you use this estimate instead? You have the option then to incorporate their estimate and to based on a slightly different assumption. It's very easy to be fooled into thinking that what investors want are perfect projections, that they somehow want these things to be exact and they want them all to be beautiful and smiley and wonderful and so on and so forth. But that's actually not what investors want. They want them to be as realistic as possible and to demonstrate that you know what you're doing. The more foolish your projections appear, the more foolish the investors think you are. Over-complexity is not generally helpful. Very often, entrepreneurs start out with reasonably simple projections and then make them more and more and more complex over time. And it's okay to have a complex model, but investors will recognize when you're over-focusing on specificity rather than accuracy. They'll know that you're focused on details rather than figuring out whether this stuff's going to actually work. And really complex models can make it difficult to figure out what's really happening. It's fine to have an amazingly complex model in the background as long as you can easily adjust it and as long as it reports out in a digestible way. So build a flexible model that can be easily changed. You're going to change it regularly, I guarantee it. Last thing we want to talk about here is scenarios and sensitivity analysis. The bottom line is predicting the future is really, really hard. I'm not good at it. You're probably not good at it. Nobody's really that good at it. And so good entrepreneurs generate scenarios based on likely outcomes. The most common form of this is where you have three scenarios: a good or optimistic scenario, a sort of a most likely scenario, and a bad or pessimistic scenario. That allows investors to see sort of where your thinking is on how this might turn out. And clearly you use slightly different assumptions. So in the good scenario, you project growth to be 10%. In the most likely scenario, perhaps you project growth to be 5%, and in the bad scenario, you perhaps project growth to be 0%. You can also use probabilities here. That gets much more sophisticated, where you assign probabilities to different possible outcomes or those scenarios. Or you can build scenarios based on specific milestones or quantitative information that you have. For example, you could say, in this scenario, we get 3 customers. In that scenario, we get 5 customers. And in this scenario, we get 10 customers. Those can be very, very powerful, especially if you have the underlying data, say how many customers you've had conversations with. Finally, a different way of doing this is with sensitivity analysis. Most entrepreneurs fail to do this, but it's incredibly powerful when talking to investors. The goal here is to figure out which are the key variables that have the most impact on outcomes. So you could take one of these scenarios, say your most likely scenario, and then you adjust a critical variable such as gross margin. So if your most likely scenario assumes that gross margin is, say, 60%. The question is, if it turns out that you can't charge as high a price as you thought, and your gross margin is only 40%, how much impact does that have on the long term of the company? Other key variables that usually have high impact: sales growth, asset intensity, that is, how much do you have to invest in order to be able to produce what you're producing. And there can be others as well. So based on what your business model is, it's a really good idea to make some hypotheses about what you think the most critical variables are, and then build your model such that you can change those relatively easily to see how much impact they really have. So this is a good starting point. It's a lot of information. Finance is challenging and difficult. It's, of course, my favorite topic. And we're going to continue this conversation to prepare you for the large-scale activity that you're going to be doing.